Okay, folks, welcome back. This is going to be a very brief review. I'll save most of what I'm going to discuss about what's transpired technically this week for the weekend review. The reason why is because I'm not going to be doing anything else the rest of the week, and that's just what we're going to focus on for right now, just the salient points. The dollar index, we had 3 up-close candles, Monday, Tuesday, and Wednesday. I mentioned on the weekend review before we started trading this week that I wasn't convinced that we were done going higher on the dollar. And this would complete the 98.40 would be the weekly SIBI, and you can see that here again. I know I beat this to death, but that's what I'm thinking the market wants to close in up here. So the rest of the week, that's what I would expect to see. Does it need to do it this week? No. It could be very frustrating and just simply not do it. But I think that would be the reasonable expectation. The market is bullish as long as we stay above this swing low. We had an order block here. Fair value gap on the daily. Came down, closed in that last week. This was some of the things I mentioned in terms of why I supported the bullish view on dollar still and not seeing this as a false breakout and then a slide lower. Again, it's one of those things where you just don't try to pick the top, okay? It may fail to make the higher high. I don't think it's going to fail. I think it's going to go higher. But it's better to err on the side of staying with the long-term trend than it is trying to pick the top or the bottom of it, okay? Because it's simply too hard to do so. At least I find it too hard to do so. Now, where are we at in the grand scheme of things? If we drop down into an hourly chart, we came all the way back up, closing all of this, and we still have this wick here. It looks bullish. It looks like it's building up consolidation, and then maybe one more run into this high. And if we get that expansion for any liquidity, think about it, this intraday high here and short-term high that formed on this candle, if I can get it to pop up right there, there has been bears in the marketplace. And you know, with this rapid decline here and then sending it lower, there's a lot of liquidity resting above that. So it's not just a matter of do we expect it to pop up to that level here, but to expand through it, and then obviously that would give us a perfect excuse to go up and close in that 98.40 weekly SIBI. So that's pretty much the framework we're looking at here. It does look a little too, perfect in terms of, you can run trend lines on the bottom of this. That makes me a little nervous. Looks, too good, too textbook. But once in a while you get those. So it might be what we get. Connect this low through these lows here. It looks like it's a support line relative to trend lines. And you know what I feel about that. But we'll see. I think that it still has the likelihood to get up in here before Friday. I wouldn't be surprised if they don't do it. And if it doesn't do it by Friday, obviously that's what we're going to be looking for in advance on the weekend review. I'll be looking for this still to close in next week. Difference would be I would expect it to happen on Monday or Tuesday. Okay, so in other words, if we fail to get above this high and fail to really break down, then you know what I'm going to start off with dollar index on this weekend. Okay, so moving on into the euro dollar. Euro dollar, this is the last time you saw our markups for euro dollar on a 15-minute time frame. I'm jumping all the way into the lower time frames for cable and fiber, simply because everything's pretty much the same thing I've mentioned at the beginning of the week. So refer to those notes. So we have this low here, the breaker. We had a fair value gap I mentioned here. We closed in the gap, consolidated, found resistance at the gap over here. Okay, and then price has heavy distribution. Trades right down inside of the middle of the last run down here. So this is all one bullish order block. It's not to be viewed as a buying scenario, in my opinion. I'm just showing you what we have here in terms of the symmetry. And here is that 50 level right there, and boom. Okay, so you can see that support being found there. I think personally, I think they're just going to run right on through that. They're just pausing it, so it's more or less crouching right above this run on liquidity. So again, that would justify also the same narrative for that bullish move, closing in the dollar weekly SIBI. Pound dollar. All right, so I mentioned last week we had some fair value gap in here. We traded up into that. Went a little bit higher, went into another fair value gap, traded right into that, creating Monday's high. Sold off, fair value gap in here, traded through that. Also, all of this down close candle right at the bottom. Now I'm going to zoom in here. All right, so we have the last up close candle before this down move. There's displacement here. So our eye would go right to this last up close candle. So if you want to refine that, you can do this. Right there. Oh, you had to move, didn't you? You booger. All right, so we have the open down to here, and then you can do right there. So really nice symmetry in regards to that. Equal high, so you know that's a buy side liquidity pool. Buy side liquidity pool, fair value gap, bearish order block. So most sensitive price point. We would start at the wick. Why? Because it's a fair value gap as well. And it can trade up, and we allow for this inerrant price action to go higher up to close into that body. But midpoint in the wick, that's sufficient. Okay, so if you want, fancy dance and entry, or you want to study, use this concept in here for your tails on your candles for bearish order blocks, and you'll see that many times you'll get this as well. So again, that's consequent encroachment as well. Now, why is consequent encroachment being utilized on the wick and not a gap? Well, that's what this is. This whole wick down here is a gap in price. It's gapping down to seek liquidity and then retracing away. Then it pops up the next candle, and then we trade completely through it, all one candle, passes right on through that wick. Okay, so the buy and sell side isn't a factor here, so there's really no imbalance. So when I say the wick is a gap, it's not that we need to see a back and forth motion yet until it trades down through it, which it does on this candle here. Then you'd expect it to trade up through it on buy side delivery, because this is all sell side delivery. So this will act like a SIBI, this single candle right here. This range, you can split that range in half. That's consequent encroachment, and that's what it does. It rebalances to this price point. So don't think that consequent encroachment is just simply limited to gaps or singular displacement candles, where we have one single candle down or one single candle up, and then finding the middle of that, like we do with candle's body for mean threshold. See, the difference is mean threshold is the middle of a specific candle. Consequent encroachment is the middle of a gap, okay, or the lack of balanced price range, which we have here. Okay, so a wick, before this even occurs, this down close candle, this wick is a gap. That's how you look at it. Okay. Then you have one single candle down. Then the range becomes a SIBI. Split it, and you can expect it to rebalance back to the middle or consequent encroachment. Anyway, price had a really nice drop there. Came back up into bearish order block again here on this day. Sold off. Rather sloppy going into the close. Equal highs. Right in here. Buy side liquidity pool. New York open. Runs it. Sends it lower. Price runs back up. Midpoint of this single down close candle into a breaker. Beautiful delivery. Look at the candle's low here. Low is 26.48, and the high on this candle, 26.48. Beautiful, beautiful delivery of price. Breaker, sends it lower. What's it run for? Sell side liquidity. And then we consolidated. Okay, so I did some work on a few pairs today, practicing. You guys saw all that. I mentioned yesterday at 3 o'clock, I posted a chart. And just so you guys know, I apologize if I confused you because I actually said something wrong. A couple people emailed me saying, "What's going on? You said you were going to put the video, or not video, but you were going to put the charts up on Monday night." True. I actually did say Monday night I was going to post it, but in my mind, I was saying I want to see what we do on Monday and then how we trade into the Tuesday. And then Tuesday will let me know what we do ahead of the rate announcement for Wednesday. So I was looking for that really to be said, but I stumbled over the top of my word. I'm doing way too many things at one time, folks, and it just was very apparent that I wasn't paying close attention to what I was saying. So I will be very much more focused on the things I'm going to say. And you can hear I have my notes and making sure I say the very specific things I want to say, not to confuse you. It doesn't mean I won't make a mistake in the future. I am human, but that's what I did. So if I frustrated you expecting to see something on Monday night, I apologize. It wasn't meant for that. I wanted to see how we traded on Monday and then Tuesday and see what kind of filters I could have for price action. And, well, you see the fruits of it. So with that said, let's go over to dollar CAD. And here we have the chart post price action. Okay, so this is what you saw last night or yesterday evening, let's say it that way. This chart is now 27 hours later. And we have the buy side liquidity pool has been purged. Buy side liquidity pool purged. Beautiful delivery right up to consequent encroachment. Rounded to a nice 5 level. The high on this candle comes in at 35.45, and then obviously the four pipettes. We were looking for an expansion here. I mentioned that we could look for fair value gaps, order flow, entry drills post the rate announcement. And I did both sides of this currency today. I did some drills on the long side and on the bear side. And I will just briefly go into a 15-minute time frame. And this level right here, you don't see it on the 15-minute time frame because I was working and exercising with a 1-minute chart. Now, some of you are already thinking, man, why are you on a 1-minute chart, Michael? Because it's the same thing. I get a lot more practice using a 1-minute chart than if I use a 15-minute chart. There's not that many imbalances. There's not that many PD arrays to work with within a single day. And while I'm waiting for certain things to get done in the tasks I'm doing to run this mentorship, I practice. I do it every single day. And the things that I want to bring out today, because I got a lot of emails that came flooding, 1 minute question mark dollar CAD, that along the same theme of that. So I'm going to kind of answer all of those emails. I'm not going to answer them independently. So please don't be mad or feel like I'm slighting you. It's just I have so many emails coming at me every single day. So I kind of use the opportunity to answer a blanket response to a lot of them. They're equally themed. Okay, so if there are a lot of, or very closely themed, I'll try to do my best to respond. Then, if it doesn't obviously satisfy your inquiry, then yell at me through email. All right, so we had the fair value gap down in here, price drop down into that. Beautiful response, run up, consequent encroachment. Now this was enough. This right here. This was the first buy side liquidity pool that we mentioned to get tagged. Beautiful, that's enough. Now it hits it, and what is it doing? It's rejecting. You see that? So the protocol I said in the post last night, you want to use your institutional order flow entry drill as an exercise. Well, you have that here. This is your fair value gap. BISI, buy side imbalance, sell side inefficiency. Price comes down, fills it in beautifully. What's it trading back to? The order block. Why is this an order block? These two down closed candles. Why is it an order block? Because it has an imbalance to the right of it. Okay, so you have BISI coupled with two down closed candles. That is your qualified bullish order block. All right, so, and for you guys that are doing YouTube, I'm aware of some of you in the mentorship that are doing YouTube videos, and I already know who you are. I will be reaching out to you this weekend. If you put anything else from the mentorship on your videos, I don't care if you delete them or unlist them like some of you think you've done. I already have videos been sent to me. Okay, so I know who you are, Navy man. Okay, so just know that we're going to be talking. And I haven't watched the videos, but if you have breached our agreement, you will be removed from the mentorship. Sorry, but I warned you. So don't give my mentorship stuff in your videos. Don't teach it, and don't think you're slick by calling it supply and demand, because it's not supply and demand. Okay. So anyway, we have the displacement on the upside. We have a fair value gap right in here. Beautiful, filling in right there. So there's one more exercise that you could have used. Expansion up into consequent encroachment, and then right in here, you can see just look at my Twitter and you'll see the exit point. I didn't want to do too many of the entries down in here or in here, because obviously people are looking at my Twitter and they're trying to figure out what I'm doing, and I'm not trying to teach it by example there. But we talked about this level here, and we were looking for this buy-side liquidity pool to be filled in. It did both. The exercise, or the idea of working within it, was, again, wait for the news driver to come out. Okay. Well, we have the spike up in here. It comes back down, hits the fair value gap, and then expands up the upside again. Right in here, I want to take you into a 5-minute chart, and you still will not see it. Okay, there's nothing here that you can see that's apparent until you drop into the 1-minute chart. Inside that long wick, remember what I said? You got to treat it like a gap. So if I take this off here, zoom out a little bit, scroll back. Right in here, the rejection block. And this is for your notes, okay? Some of you may not have got to the rejection block yet in your studies, but this is what you want to be paying attention to. Okay, this is one of those further high-end things that I keep to myself, but I promise you get it over time. So I'm showing you something that I wanted to hold on to until next year, but I got a couple folks in here that feel like we're not going forward with anything new, which I don't understand what that's all about, because I'm teaching you all kinds of stuff every month. The highest up close candle in the swing is the rejection block. Okay, no, it's not a pin bar. No, it's not anything else. It's a rejection block. The last up close candle, the highest up close candle, that's the specific level. It has nothing to do with the pin, okay, or the wick. Okay, that's the specific price level you're looking to see it trade back to. It does so here. Okay, look at my fill. Okay, look at my fill for my short, and you see that's exactly what I nailed. Okay, I went in there, sold short. In this portion of price action, this up close is right here, but the expansion on the upside, if we treat that like a fair value gap, okay, order flow, entry drill, if we trade up to it, all it has to do is breach or trade above the rejection block. That's why it's a rejection block. That's the procedure or protocol that you use, why it works. Why is it going to work? The same way you would see if this was say it was a SIBI, okay? We only need to use the next candle, which would be here. If it trades above that candle, that would be enough for our entry if we were trying to sell short on a bearish fair value gap or a SIBI, sell side imbalance, buy side inefficiency. In this case, I only need the rejection block price, and that price is 135.40. So if it trades anything above that, and you can get that price, sell short there. Your stop would be just above whatever the high is. Okay? You can sometimes, if you can watch it real time, and I've done this lots of times, looking at the high from the from the high to the close, that range or that wick, if we split that in half, consequent encroachment, many times it'll trade just to that price point. Now, I don't require it to do that, but many times you'll see it do that and keep this wick intact and not breach it. So there's two reference points that you can use. Now, obviously, like I teach you, I like to use the low-hanging fruit entry style. I'm not trying to get too fancy with it, and that's all I use to get in and go short. It was the rejection block on on a 1-minute chart. Then we had this right in here. Okay, now we have a BISI, buy side imbalance, sell side inefficiency. All the way down into here is where I expected price to trade back to, but I only required it to trade to 135.20. So 135.20 plus the spread. That would give me an exit rate on this candle here. Beautiful enough to send us lower to clear, cover the spread, and price traded right back up to the top of the imbalance, and then finally comes all the way down and fills it beautifully. This is a 1 minute chart. Now, if I were to show you and didn't say anything about the specific time interval, if I would have said, okay, look at this 15-minute time frame, you would just take my word for it. Okay, yes, it's probably a 15-minute time frame. If I wasn't telling you the price or anything like that, you would just say, okay, you go along with it. It's the same thing on all time frames. Everything about price is fractal. So if we understand the essential tenets to price being delivered on the buy side and the sell side and how it seeks liquidity, nothing changes because we go to a different time frame. It just means that the length of time for the formations and setups to come to fruition and to complete are much, much more frequent. And because it's allowing me a lot of opportunity to practice, that's what I did the 1 hour. I keep calling it 1 hour, the 1 minute chart today. Okay, so that's that. And then you can see we've pretty much been chopping wood, banging around inside that range and staying very close to it. And we are still within it, okay, or very close to it. And I'll zoom out again. This is all, again, 1 minute. That's it. So if we were to consider the protocols for institutional order flow and the order flow entry drills, let me zoom in here. Look at this fair value gap right here. See that? Boom, hits it. What's it run to? The rejection block. Okay? I got to remember, okay, Larry, this is for you, buddy. You mentioned, how about a solid trading plan? I've given lots of them. Okay, lots of them. Okay, it's all throughout the course. Okay, all throughout the core content. It's in the weekly reviews, it's in the daily reviews, it's in the specific teachings. But I want to kind of like just toss this out. When we consider a trading plan, all right, number one, you have to have a premise. Okay, what's the condition in the marketplace that you're going to be operating in? So when I suggest these price action models, what I'm trying to do to you is stir your imagination to lean to one of them. Any of them will make profits. All of them will do it. Okay, but they have to be utilized at the right time within the current, with the current market structure in alignment with it. So when we look for a trading system or a trading plan, okay, you start off with a premise. You start off with a condition. What leads to you being bullish or bearish? Okay, obviously we know that that's order flow. It always starts there. Always. Now, once we understand how order flow is derived, if we're bullish or we're bearish, then we have to look for a setup. So we have a premise in mind, what makes us bullish or bearish. Okay, and we always understand that that's order flow, seeking liquidity. Where's the draw on liquidity? There you go. There's your bias. There's your underlying premise. Now, I've given you scores of lessons on how to determine that on any time frame, working specifically from higher time frame into the daily. Because if we focus on the daily, like I always do in the reviews, not so much today because it really isn't too much to talk about here, but from this weekend that just passed, I gave you the review and the advanced perspective on the daily bias, where we think price is going to reach for and why it should do that. That's what I'm trying to communicate to everyone, because the daily chart is going to facilitate the premise or condition for any one of your styles. If you're long-term position trading, it's still going to help you. If you're going to be a day trader, it's still going to help you. If you're going to be a scalper, it gives you the highest probable direction to work within. If you're a swing trader, it's still helping you. That's why I do and preach from the daily chart, because all of the interbank dealings are going to happen from this bias on the daily. So if you want to determine what type of trading plan you're going to be working with, you have to determine what style. I can't do that. That's why I give you a mix of different price action models. Again, I'm not trying to force you all into a specific mold. But once you have that criteria of what you want to work within, what time frame type of trader you want to be, then you can scale that to any time frame. It does not have any limitations whatsoever. Okay, the only limitations are there's certain intraday tools, obviously, that won't be applicable to a daily chart. So, with that said, everything about order flow is the same thing on all time frames. So you have a condition or premise, bullish or bearish is what that means, and then you have a setup. What is your setup? What is the thing that triggers you to take participation in the marketplace? Well, if we're bullish, okay, say we're bullish. We're bullish here. We have a displacement. The market comes down, closes in a fair value gap here, bullish order block. That would be a setup. You're bullish. What's it bullish? What's it reaching for? Rejection block, potentially running up to the old high. It could have done that. Okay, but this is a perfect opportunity for you to scale out too, because that's a premium array. You could be long here. There's your premise. Okay, bullish. Entry technique is a bullish order block and filling in a fair value gap. Okay, there's your long. Your stop would be below the order block plus spread. Okay, there's your entry technique. So now you have premise, setup, entry technique. So how do you take profit? You look for opposing liquidity. Rejection block, bearish order block. Why this one? Because it's the highest up close candle body. Inside that order block, you have the low, the mean threshold. That could be a profit objective for you. Then you have the rejection block. And then leave a little bit on to see if you can get above that and make a higher high. Because it could have closed the weekly SIBI completely today. Think about it. If we have, well, it wasn't weekly SIBI, I said that for the dollar. This is the daily SIBI for dollar CAD. Okay, so this was the high we used for defining the consequent encroachment and the unfulfilled range on the upside of that SIBI. So dropping back into a 1 minute chart. Take that off. So you could use that as your entry. Now, some of you may say, okay, I liked order blocks before, but now I just really want to trade into the fair value gap. I trust that more. Well, again, it's not one better than the other. It's just which one's available to you right now. So you have a fair value gap in here. Single candle, previous candle, previous candle. So there's your gap. Trades into it beautifully. Bam, hits it. What's wrong with that? There's nothing wrong with that. There's your entry technique. Where's your stop loss? Below here. So what are you holding on for? Same thing. See if you can get a piece of the order block low, which would take us right above the swing high after it retraced. Well, there's going to be buy-sell liquidity resting above that anyway, right? Now, yes, this is a 1 minute chart. It's not that much range, but you still practice like this. This is what you do. I'm doing it too. Rejection block is a potential upside objective, and then leaving a piece on for another run higher. Okay? Well, how is that not a trading plan? That's a trading plan. And I have done this dozens of times. In the core content, I've done it in the weekly reviews, in the teachings. It's not going to get spelled out any better than that. Okay, that's it. That's the whole reason why you have to go through the core content. See, some of you want me to type up a beautiful little PDF and put charts together and all that. And what's going to happen is folks from South Africa and Mexico, Colombia, Russia, North America and South America, okay, they're all going to be selling PDF files because it's going to be a ICT sponsored complete trading plan. Okay, I'm giving you the details. Okay, I'm going to give you the details on how to put it together because you've gone through the content. I just gave you another trading plan. And it does not limit itself to a 1 minute chart. It's on any time frame. Okay, anything. You have to be comfortable with trading it. I can do any of these things because I authored them all. But you are going to have to start with one. Get real comfortable with it. Practice with it. Okay? You may outgrow it for something else. But it doesn't mean you don't ever use it again because you will many times see something setting up and say, okay, I don't usually use this model, but it's right there, so I'm going to practice with it. Or if you end up eventually trading with live funds, that may be your trading plan. So don't think that or imply that you haven't been taught trading plans okay, because I've given you all of the gears, and I put them together for you, telling you what to do with them, okay? You know when to take profits. You know how to find entry techniques. You know how to nix the trade, what makes the trade no longer valid. You know where your partials should be. Okay, these are all things that you've learned in the core content, or if you're new and you're going through it, you're learning all those things, okay? But there's so many other ways to do it, it's limitless. Because price is fractal, you all could be watching a particular pair in a specific time frame and taking a very valid setup. And I could be very easily doing something completely opposite in a direction that would be opposing to your view and still be able to find profit in that. And it's simply because I understand all the time frames and I know how the price is going to be delivered. You have to start with one model, one approach, and grow from there. And remember, you're not going to get just because you spent 1 year with me. I can't believe I've been here for a year and I haven't been given a trading plan. Come on, Larry, you know better. It's been several times, okay, I've done that. Okay, so look at what you've got in terms of the content. Okay, go through all of the core content, find out where you lie for your specific criteria, what you like to do. If you're a day trader, if you're a short-term trader, scalper, position trader, it's all the same. It's all the same. You're just going to apply it to a higher time frame for the longer term moves, and for real quick, high velocity turnover for equity, it's going to be the lower time frames. Okay, but they're all going to be doing the same thing. It's all about liquidity and finding fair value between those 2 price points, and that's it. You wait for displacement. Okay, that means there's energy. Okay, the rock has been dropped in that still pond, and then you have that ripple effect. That ripple effect is what we wait for. That's how we know something's taken place, and now we're going to follow those ripples out. We're not trying to counter it. We're not trying to reverse those waves that are manifesting from the center where that rock hits the water and spreads out in circles. We're trying to ride that all the way to the shore. Now, wherever that rock is dropped, okay, is going to be up to smart money. And how big of an impact it's going to be in displacement is going to be up to smart money. We don't care. We can see what the displacement causes, and then relative to that displacement, like this right here, we know that the range is what? High to low. We're below it down here. We're below midpoint. Okay, so we're in a discount. Trading back down to this midpoint here, what is that? That's a valid bullish order block. Trading within a specific range. Next to equilibrium, below equilibrium, still the same thing. It's a discount. And you trade it up into a premium. A premium array is the rejection block. And I just taught you tonight how to use the wick. Treat it like a gap. Okay? You only need it to trade just above that candle's close. Just like you would treat it as a fair value gap for institutional order flow entry drill. We only need to go up into the gap by just breaching the low end of the gap. And that's what's happening here. Because IPTA sees this as the same thing as a fair value gap. All right? And that, folks, is going to be it for tonight. I will share with you a weekly review on Saturday. It'll probably be 6 p.m. this weekend. I apologize, but there's just so many things we're doing with the family on Fridays and Saturdays now. It's going to be later in the day, probably on Saturdays, because we have soccer games and we have other things we have to do, and it just can't be everywhere. Okay, so I have to do those things first, and then I will get you guys what you need before Sunday's open. Okay, so that's going to be it. I'll catch up with you by way of recorded video this Saturday, 6 p.m. my time. Until then, I wish you good luck, good trading.